Hi, it's Mark from Caliber Home Loans, your mortgage advisor. A lot of my clients ask me, how exactly are interest rates calculated? And, we always tell people it's based on credit scores and what you're buying and how much you're putting down and program. But I thought I would do a deep dive with you today. So it's going to get a little nerdy, but I just want to give you a heads up. So mortgage rates are based on risk assessment. So remember that somebody's writing a check on a house that they don't own, technically. You own it. The level of risk is based on credit scores, the amount of the down payment, whether it's a single family residence, a condominium, a multi-unit, 2 to 4 unit, whether it's a purchase versus a refinance versus a cash out refinance, whether it's a primary, a secondary, or a vacation home or investment property, and then based on your debt to income ratios. Now, this is just for conventional mortgages. VA, FHA, and rural development do not do this, do not have loan level pricing adjustments. So Fannie Mae and Freddie Mac use what's called loan level pricing adjustments to increase your interest rate as the level of risk increases. Loan level price adjustments are nothing more than points that Fannie and Freddie charge the lender based on the level of risk for a particular borrower. So as the risk goes up, we as the lender will pay a fee. There's two ways to pass that on to the borrower. We either increase the rate to absorb that fee, or we charge the fee outright. So the amount of points increases as the risk of the loan increases. So this is what's called a loan level pricing adjustment chart. This is actually from Fannie Mae, but Fannie and Freddie use the same numbers. This is what's currently being used, at least for the next probably week. So you see that the credit scores go from 620 to 780 on the chart, but currently we top out at 740. We've never gone above 740 for as far as determining risk for as long as I've been doing this, for 30 years. But I put this in the chart because the new numbers go all the way to 780. So you notice that there are zero adjustments as you get to higher credit scores and less down. So this is for your purchase money loans, purchases. So this is for the rest of the types of loans: just rate mortgages, condominiums, investment properties, second homes, manufactured homes, 2 to 4 units, high balance loans. In certain states, their loan limits go above what we can consider the normal conventional loan limit. High balance ARMs, and then debt to income ratios over 40%. So we've never had a pricing add-on for debt to income ratios, regardless of what they were, until now. So these are the new charts. So now we go from 740 all the way to 780. And you'll see, again in yellow, where there is no adjustment at all. So to compare the two gets a little bit dicey. So this is for the purchase, and this again is for the rest of the types of loans: adjustable rate mortgage, condos, investment properties, etc. Again, the zeros are where there's no adjustments. So what we did is we put together this chart we call it a heat map, but it's the changes. So the values in green represent improvements. In other words, Fannie and Freddie are not charging the lender as much as they were before, and the values in red they're charging more. So if you take a good look at this chart, you'll notice that the lower credit scores at the higher loan to values or the lower down payments, they're actually getting a better break than the middle of where it's red or pink. In the middle of the chart, from really the 680 all the way up to 780, depending where you are in down payment. So that's a huge change from where we're used to. And then again, for the rest of the types of transactions, there are some increases and decreases depending on what we're looking at, but they did decrease the 2 to 4 unit a little bit depending on what the down payment is. But you'll notice at the bottom it's circled debt to income ratio. If the debt to income ratios are over 40%, now there's a 3/4 point hit. I'm sorry, 0.375 hit to the points, so the rate's going to go up, or you would be charged that. Most people don't pay the points; they just take the higher rate. So the updated LLPAs that are being implemented by all lenders is the biggest change in my 30 years of originating home loans. So these changes are for all loans that are delivered to Fannie Mae and Freddie Mac on May 1st. So in order to make sure that the lenders aren't having to pay these fees out of pocket that they didn't expect, most lenders have already implemented these changes or are about to implement these changes. So there are three programs out there that actually don't have any loan level pricing adjustments to them, regardless of credit score or down payment, or whether it's a condo or a house. And that's a Fannie Mae Home Ready and a Fannie Mae Home Possible. Those are not just for first-time home buyers, but the borrowers have to have at equal to or less than 80% of the average median income of where the house is located. And then the new product is called 100% AMI, or 100% average median income. Now that is for only first-time home buyers, or if you're buying in a rural area, or if you're buying a manufactured home. So there are some possibilities that we can get rid of all the loan level pricing adjustments. And this is a big change also. So again, with these programs, if you qualify, it's a much better deal because your rate is going to be the best rate on the rate sheet. So give me a shout. Let's talk about this. Let me see where you're at. Let's see what you qualify for, don't qualify for. A lot of times, if you qualify for MSHDA, right now MSHDA, the non-down payment assistance program, their interest rate is actually below current market rates. So if you qualify for MSHDA, that's probably the best deal going. But give me a shout, 248-705-8431. Let's talk about what you need to do to get into your home.